TheoTrade. This is Don Kaufman. It's January 15th, 2025. Just about 45 minutes to go to the cash close here on this, ripping Wednesday afternoon. S&P futures are up right now just shy of 2%, 116 points. NASDAQ on fire. 500 points, good for 2.5%. I mean, this rally, well, it's the hallmark of any volatile marketplace. I'm actually going to explain that and much more here, of course, on this TheoTrade evening update. So let me state the obvious. Well, the S&Ps are actually sitting, here we are, at 6,000. So you're in the midst of a rip and rally, and the rip and rally, of course, is sparked by what was interpreted as maybe inflation cooling off a little bit. So the CPI comes out slightly softer than expected. Not sure anybody believes those numbers, but the CPI comes out, okay, which is right, inflationary indicator, comes out slightly softer than expected. And with that, we're on fire. So the marketplace explodes to the upside. But check this out. From my perspective, okay, here's my perspective. This is the expected move in the SPX. And to me, it's like you can look at this and you can prognosticate about any one of the stocks in here. But bottom line is, yesterday we closed. This is kind of unchanged. We popped to the upside, hit the upper edge of the expected move. Do a little dance, make a little love, get down tonight. That's your trading session. So the rally right now is kind of this like vicious, reflexive bounce, but the bounce just took us exactly where we're supposed to go. I'm going to say exactly where we're supposed to go. In the weekend update, I talked about a fairly significant expected move, and you should, anticipate some big movement. The expected move this week was roughly plus or minus, okay, about $117. So ironic, too, because we're home. So what? You got a $117 move. But what I'm bothered by right now is a lot of traders, they have tendency to look at this. So I'm going to cruise back over to the S&Ps. They have tendency to look at this and they're like, that's it, Mortimer, we're back, we're rallying again. Yeah, but if you do start to draw some like trend lines in here, it's pretty good. You're still in this pretty significant downtrend in there. Again, we can draw a number of different channels any way you want to do it, right? You're still basically in the midst of what is a downtrend until told otherwise. You have to sit here and assume one day, okay, sure, it's a rally. But this is, what people often call like a rip your face off rally, the dead cat bounce, a bear market rally. Okay. To me, though, I just call it like if there's like a check mark to be placed in this marketplace around a specific event, it's always the rallies that do it. Meaning that, it's always the rallies that like, oh, wow, this is a really like wild, volatile marketplace. But the hallmark of that volatility is always inevitably what we term the rip your face off rally. And this is it. The weird thing is in here is that, yeah, volatility is definitely subsiding. There's no question. And volatility should subside. Now look at the volatility futures and, they were very, very close to being flat vol skew, even actually going into what we call backwardation. So they're definitely cooling off. Okay. And I looked down and I read like VVIX, you're like VVIX, the volatility index, and it's cooled off to like 99. Okay. But before anyone starts high-fiving one another, okay, you still have incredibly high degrees of correlation. At times today, okay, the S&P 100 had like 93, 94 advancers. That's the S&P 100, 93, 94 advancers. And the reason that matters is that basically means that individual stocks, okay, no one cares. The marketplace is moving kind of as a unit, right? So which is, again, that's also one of the hallmarks of volatility. And the reason I'm going into some depth about that is, there's all right. So Nvidia, it's got its feet back under it, up about 3.5%. Tesla is ripping. Okay, in here, you've got Meta, nice little bounce back to the upside, yada, yada, yada. Okay, there's not really a reason, though, to look so much at individual sectors or individual products because they're all moving in relative unison, right? That's what higher degrees of correlation are. And with that, yes, you should see the marketplace volatility drop. Now, for the areas of contention, one of them happens to be the US dollar. The US dollar, okay, backed off a little bit, but has actually rallied back up quite a bit. So this is definitely an area of kind of contention because initially on that CPI number, that thing dropped like a rock. It's actually been rallying back throughout the course of the day. That doesn't exactly leave me warm and fuzzy. Like I'm not high-fiving anybody about this. And this is the stuff you need to kind of focus on is that, so number one, we rallied, okay? But a lot of people are not aware we rallied right to where, well, we're supposed to rally, and that happens to be kind of the upper edge of this expected move. Like it wouldn't surprise me in the after hours, we come back down, do a little dance, make a little love again, get into, it's 59.45 is the upper edge of the SPX expected move, which, by the way, I have a butterfly sitting right on it. Okay, spot on with a butterfly. So that's one of my areas of contention is the dollar. The other one is we rallied directly, okay, just to a level that, well, we expected. That's why we call it expected moves. We're not doing anything stellar, okay? I mean, it's stellar to see like a 2% move, no doubt, but the marketplace is adhering right now right to the expected move. The other area of contention, so we have the dollar, okay? We have the expected move, okay? The other real area of contention here, it's the bond market. The bond market, out of the gate this morning, that thing went soaring higher because they're like, okay, inflation is cooling. That way, the bonds rally, interest rates go down. Remember, bonds rally, interest rates go down. Okay, so, all right, but the bonds also, they've already cooled off some about 15 ticks. And to be quite frank with you, I just don't think the bonds have rallied enough. I mean, this is indicative right now. This is a bear market rally. This at this point, specific to the bonds. Let's just be specific to the bonds. The S&Ps, look, retail sales is coming out tomorrow morning. If the retail sales comes out and they're like, yeah, retail sales is good, how's the market going to react? Is it going to be positive or negative? Frankly speaking, I'm not even sure because a positive, like if the retail sales are really, really good, that's kind of inflationary. Okay, but if the retail sales are bad, you're like, oh, and the CPI, okay, it's a huge catch-22. So I can't look at the data that's coming out. All I can look at right now, it's right in front of me, and you call whatever you want. Okay, the bonds have been getting absolutely crushed. They haven't had an uptick. That, okay, it's a nice move to the upside, but it's not enough to actually convince me. Okay, at this point in time, my assumption is that the S&Ps, look, they may have a little bit more room to the upside, but I actually think it's an opportunity to possibly fade this marketplace. Okay, that would probably be the opportunity. And I'm going to look for opportunities to fade specific underlyings over here. And again, I'm going to be very, very specific at this. Okay, there's a lot of earnings coming up. So much of what I am going to be doing is probably going to revolve possibly a little bit around, okay, some of the major ETFs out there. Because again, the reaction, although positive right now to CPI, give it a few days to kind of bake in and keep a really good eye on the dollar and the bonds. The bonds back off, okay? Or if the dollar actually starts to rally, I would assume that this S&P rally was over. Again, before you get all hopped up and start high-fiving one another, we rallied. No question about it. But we rallied right to what was expected. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.